Hello, everyone. Good morning, good afternoon, depending on where you're joining us from. My name is Courtney Drake, and I am so excited to welcome you today to what is one of our most popular webinar topics of the year, 2023 tax changes. It's that time again where we invite not one, but two of Avalara's tax experts to shine some light on what have been the biggest tax changes of the last 12 months, what they mean for your tax obligations today, and the trends that we can expect to see evolve in 2023. Next up, I would love to introduce our speakers. So first up is Nicole McDonald. She is Avalara's Vice President of Compliance Services. Nicole leads Avalara's managed returns and registration services across several of the tax verticals that we work within, including sales tax, beverage alcohol tax, and the list goes on. She also holds her executive certification in blockchain for businesses through Columbia University. So she has a wide array of knowledge, and I'm really excited for her to share her perspective on the tax changes that are happening today. Nicole, it's great having you here. Thank you for joining us.
Super excited to be here, and we have a lot of great content to share with you.
We certainly do. And next up, as I said, we have not one, but two of our tax experts joining us today. Scott Peterson is also with us, and he is Avalara's Vice President of U.S. Tax Policy and Government Relations. Scott previously worked as the Director of the South Dakota Sales Tax Division for 10 years, and he also led the Streamlined Sales Tax Governing Board, which is an initiative we're going to talk a little bit about later today, but it's devoted to, making sales tax requirements simpler for businesses. Most recently, Scott was named in Accounting Today's 100 Most Influential People in Accounting for the 5th consecutive year. So Scott, congratulations on that. And as usual, it's always great to have you. Thanks for being here.
Thank you, Courtney. I'm excited about talking with our attendees. This should be fun.
Absolutely. All right. Well, before I let our speakers take it away, I did want to dive in and just go over the agenda and what we're going to be, some of the topics that we're going to be covering today. So first and foremost, I'm actually going to take us through the current state of commerce and some high-level stats of what we've seen over the last year and where we are today. Then we'll go into some current trends in the economic landscape and the surprising tax implications they can have on your tax obligations. We'll also talk about the latest in economic nexus laws and marketplace facilitator laws, what you need to know there. We'll also feature some state-specific updates that you need to know, talk about taxation in the digital age. So we'll talk about taxation in the metaverse, NFTs, and Maryland's recent digital advertising tax. And then we're going to close out talking about some international e-invoicing requirements that businesses need to be aware of before we go into Q&A. So with that, I did want to take us into our first kind of main topic here, which is the current state of commerce. And this will be the last slide for me, I promise, but just wanted to provide a look at where we're sitting today. So sales through both offline and online channels actually reached $1.22 trillion in the last quarter of 2022. And that's up about almost 8% from where we were a year ago. So that's up from 1.13 trillion in Q3 of 2021. So we're seeing a lot of strong numbers still coming in from commerce. E-commerce is also still on the rise. It's not quite at the same record levels that we saw in 2020 and early 2021. But we did see that digital revenue hit $251 billion in the third quarter of 2022, by no means a small number, and that almost 21% of all dollars spent on retail purchases in Q3 of 2022 came from online orders. So we're still seeing a lot of strong numbers, especially as it relates to digital commerce. However, according to the International Monetary Fund, and I think there's been lots of talk about economic downturn possibly, International Monetary Fund is forecasting that global growth is going to slow in 2023. So it was 6% in 2021. They're saying it will go down, or did go down, to 3.2% in 2022 and is expected to reach 2.7% in 2023. So according to them, things are going to slow down just a little bit. So it will be interesting to see if and how things shift in 2023 and the inevitable effect that that always has on tax compliance. So with that, I'm actually going to pass it over to you, Scott, to talk a little bit about our current economic landscape and some of the surprising tax implications that can come up from that. So I'll pass the mic over to you.
Thank you, Courtney. Appreciate it. So we're all talking about inflation. Everybody talks about inflation these days. And one of the reasons why we're going to have an economic slowdown next year is because the Federal Reserve is trying to slow things down. And they're trying to slow things down by making it, by raising the interest rates. Interest rates makes us think less about doing spending. You know, I don't want to put more money in my credit card if it's going to be a higher interest rate. I don't want to go out and borrow money to buy a house if the mortgage rate's going to be higher. And I mean, so the point of that, of their effort, is to slow things down. And that if the economy doesn't slow down, I don't know what the Federal Reserve is going to do to get inflation under control. That is one of the very few tools that they have. If you've been paying attention to the, and I'm sure you have, to the world of state tax collections, you'll know that the states are flush. They've got more money than they have ever had before, more than many of them could even imagine they would have before. And a lot of that, there's a variety of reasons. Inflation is one of the reasons. As things cost more money, then to the extent that you and I have the capacity to continue to spend like we were spending, notwithstanding the price of things, states will get more sales tax collections. Some situations, though, it is I mean, inflation really is kind of an odd thing when you're thinking about what states drive state budgets. Income in and of itself is going up because wage increases is part of the reason why we're having the inflation we have. As wages go up, we pay more income taxes. So states that have personal income taxes are going to earn more from what we earn than they did in the past. So inflation increases state income tax collections to the extent that wages go up to match inflation. If wages don't go up to match inflation, then inflation has no effect at all on personal income tax collections. Obviously the sales tax should be directly tied to inflation. But as I said earlier, it's a function of if you and I continue to spend the way we have historically spent. And that's an unusual kind. That may be the case in the first 2 or 3 months of inflation, maybe 4 months of inflation. But after you and I decide that inflation is here, we're going to reevaluate how we spend money. And we're going to switch to less expensive things, or we're going to spend less money altogether. If that's the case, then state tax collections don't necessarily go up with inflation. Inflation, you know, it's been with us forever. In fact, the Federal Reserve is trying to get to an annual 2% inflation rate. So, well, not having inflation is not something the Federal Reserve wants, but it's a function of where the inflation sits. You know, the vast majority of states don't tax groceries. So if the price of bread goes up in almost every state, there's no corresponding increase in state tax collections because they don't tax bread. The few states that tax it, they will get more tax collections, you know, all things being equal when there's inflation. Same thing with motor fuel. The overwhelming majority of states, in fact, nearly every state, the motor fuel tax rate is not a percentage of the price. It's a flat amount. It's 23 cents a gallon or it's 40 cents a gallon. And so in many ways, inflation at the gas pump decreases state motor fuel tax collections because you and I will change how we drive as the price of fuel goes up. And so when the price of fuel was really high last year and earlier this year, I mean, folks were actually thinking about, okay, do I really need to go to town today? Can I carpool with somebody? Can I go to town once a week instead of once a day or every other day? And so we were spending less money on gasoline. And when you spend less money on gasoline, state motor fuel tax collections go down. They don't go up. So inflation has a counter-cyclical effect on state motor fuel tax collections. So the food prices go up 10%. That doesn't necessarily add anything to state tax collections. Energy prices go up 17%. almost always reduces state tax collections. Medical care prices go up. The only state in the country that taxes medical care is Kentucky, and they're going to start on January 1, and we'll talk about that later. But when inflation hits the cost of our health care, most of us have to cut back somewhere else. So an increase in the cost of medical care will likely reduce state tax collections, because you and I have we've consciously decided to spend less money on something that may be taxable than because we have to spend money on medical care. Now, it may be that we just stop having vacations, and that the effect on vacation spending is so difficult to estimate that it's virtually impossible for a state economist to look at the price of anything and say, oh, this is going to harm tourism, unless it is gasoline. So gasoline is one of the very few things where if you're a tourism state, if you're Nevada, you're South Dakota, Wyoming, if you're a state who has a significant tourism industry and the price of fuel changes how people travel. And that is one of the very few areas where they can look at inflation and say, okay, this is going to increase this is going to reduce the number of people that travel to my state. So I can then roll through my economic analysis and determine there's going to be less money spent on hotels, less money spent on food, and less money spent on admissions. All those things are taxable in my state. And so I should have a corresponding reduction in my sales tax collections when the price of fuel goes up. So if you're a tourism state, the price of gasoline in the summer affects who's going to travel and where they travel and how far they travel. And so the price of gasoline goes up, reduces your motor fuel tax collection because you and I drive less. And because we drive less, that means we drive less to the neighboring states for tourism, and that state is harmed too. So the price of fuel really is a negative effect on state tax collections for a variety of different reasons. Sales tax holidays, in the olden days, were kind of driven by retailers as a way of getting the state to help them, promote retailing in the state. With high state budget surpluses, they're also a way for states to return money back to consumers. And they're frankly a very efficient way for states to return money back to consumers because the state doesn't have to do any work. So if you're a state and you have two choices, I can write a check, I've got this enormous surplus, I've got to do something with it, I've got to get back to the consumers in my state. I can write them a check, which costs me $9 every time I write a check, or I can just create a sales tax holiday and make all the retailers in my state pay for the tax administration. So what the state gains from a sales tax holiday, if their motivation is a budget surplus, is the complete transfer of the cost of administration to the retailers. And this, with the ever increasing number of holidays, goes the ever increasing cost of tax administration for retailers. Sales tax holidays are complicated. Florida's holidays overlapped each other. They can not, in some ways, conflicted with each other because they applied to the same products. Many of them were price driven. If you go out and look at what we've written on the Florida sales tax holidays, you'll see that their Freedom Holiday, which is the one designed to encourage people to go outside and do things on the beaches in Florida, it's all price per product driven. So the first $17 of a pair of swim fins are exempt from the sales tax. The first $35 of this, the first $10 of a t-shirt are exempt from the sales tax. Well, if you're the retailer, you've got to figure out how in the world you're going to manage a price-driven sales tax holiday, lasts for a weekend, for the 3,500 different things that you sell that are all treated differently by the state for that particular weekend.
Both Courtney and you talking about just the overall macroeconomics around inflation and impact on pricing. But I think what's unique about where we're headed now, particularly thinking about U.S. business, is also the supply chain factors that are driving inflation, right? Particularly in areas both in discretionary and non-discretionary spending for consumers. But let's talk about that supply chain landscape, because it's probably the new norm. It's been kind of crazy, and it's such a vital impact on the goods and services price that we see globally, right? So whether it's production constraints for semiconductor chips, which are vital in a lot of the technology and electronic industries, right? Over 30% of them manufactured in Taiwan, and put even more emphasis on that in China, right? Or looking at what we've talked about, just increased fuel prices. Separate from the tax we may pay, just the overall price of that, whether you're a business or on the consumer end of that, really has a huge impact, right? We see businesses are consistently facing these challenges as a new norm. And I just wanted to share a few highlights in really this great survey, the research that SAP has put together on supply chain issues, right? Particularly after surveying U.S. business leaders. I think, Scott and Courtney, as I hear from, the inflation and some of the dynamics already that we've discussed, the increase in commerce, right? One of the significant things I noted in the research that's published in that SAP survey is around our U.S. inventory management system. I think we see it here on the slide referred to as, just in time. And seriously, I think if from COVID to global economic challenges and global political unrest, what it's taught us is just in time is out the door, and really just in case inventory management is what's in the door, right? It's that shift to inventory management through more of a contingency planning model. And that's changing everything from real-time monitoring and tracking of supply chain inputs using technology. And it also is showing up across businesses in that shaping of vendor and supply diversification. And that means more suppliers, more vendors. That could be in the U.S., right? That businesses build relationships with to, again, de-risk relying on a single supplier. And it could also mean international suppliers. So when we think about the impact of that from a tax compliance point of view, exemption, certificate management, and reporting for your tax exempt suppliers, right? And that just increases the visibility on that with more suppliers. Thinking about that also in the context of, a lot of the drop ship and who owns taxability when you look at drop shipments. We'll talk a little bit more about that in depth. And then looking internationally, cross-border and international VAT tax, for instance, if you are working with international suppliers, is always something to keep in mind as an additional compliance factor. And we see here in the SAP survey, those changes in regulations and compliance are also about the expansion of knowledge that it takes to really move to that just-in-case model and maybe even a more global supply chain. So with that, Scott, I wanted to turn it over to you just to walk us through maybe a little bit more in depth on some of the tax compliance impact supply chain.
Often a challenge that goes unappreciated, and Nicole talked about exemption certificate management. There's an annoying and yet almost mandatory rule inside a state sales tax law, which is every sale is taxable unless you can prove otherwise. And you get to be the ones who have to prove otherwise. So retailers, manufacturers, wholesalers, service providers, it almost doesn't make any difference what type of business or association or organization you are. If you're buying or selling, that state law presumes that it's a taxable purchase or a taxable sale. And the only way to make that different is for the buyer to provide to the seller a certificate that the seller can keep in their records when they get audited to prove that the buyer said they were an exempt entity, or that the buyer said they were going to buy that product for resale, or the buyer said they were going to buy that product to incorporate into their manufacturing process. And that is the burden of the seller. The buyer has to provide it. Seller has to ask for it. Often buyers don't provide it. You have to get it from them. But the sellers have to ask for it. The sellers have to keep it in their files. It has to be up to date. It has to be accurate. And all that's a burden that state law imposes upon sellers. And there are so many different exemptions out there that it's really nearly impossible to keep track. I mean, the state of Kentucky has 17 different exemption certificates. And it's just standard course around the country that if a state legislature creates a new exemption, they will often say, and we want you to come back in a year and tell us how much this exemption certificate cost us in actual sales tax that doesn't get collected. Well, the only way the Department of Revenue can do that is to figure out some way of tracking that. So they have to either change the tax return to make you report that separately, create an exemption certificate so they can go out there and look at you and say, okay, show me all the exemption certificates you took from this brand new exemption so I can create a report to the legislature. So what the supply chain has done is created a kind of a revolving door of buyers and sellers. And that revolving door, you can't, so tomorrow the person that you've been buying your products from is, they've gone out of business or they've changed their products. You don't want it anymore. They used to be a great product. It's not a great product. You don't want it anymore. So you're constantly out there looking for people to provide you the inputs that you need to run your business or to sell to some other business. And with the supply chain issues that we had during the pandemic, there was a lot of people that couldn't get what they wanted. And they had to find it somehow, some way, which they often meant that they created a new relationship with a different provider. When you do that, you must have in process a place to capture the exemption certificate documentation that you're going to need, or be prepared, if you're the buyer, to be giving that exemption certificate documentation to the seller that they need. This one of the issues that we struggled with certainly in 2020 was, the Wayfair decision was just 2 years old in 2020. And we still had an awful lot of buyers and sellers that were trying to come to grips with the complexity associated with collecting sales tax or being asked by a supplier to provide a resale certificate because all of a sudden they had Wayfair-driven economic nexus. And that happened at the same time that the supply chain went to heck on us. And so there was this massive confusion and massive need for more and more documentation. Cole and I will talk here in a few minutes about the Wayfair decision. It is really, really impacted the way people do business. So next we're going to talk about economic nexus. Let's talk about Wayfair.
Let's do that. It's funny to talk about something that happened in 2018, right? When we can barely keep up with what's trending, 15 minutes ago. So I always look at the opportunity around just fast forwarding as well as, grounding us on why even something in 2018 is still manifesting as such just a big factor in what we do, particularly around sales tax compliance and reporting. Again, economic nexus laws really were imposed as a result of the Wayfair decision by the Supreme Court in 2018. And really the focus was on remote sellers. I mean, the economic nexus is really just a fancy word for you don't have presence in my state, but you do enough business in the state, and economically states want to benefit from that. And as we've seen nearly every state with a state sales tax already bring to the table, right? 45 states with state tax. I think Missouri, Scott, I think that's the last state due to actually roll out economic nexus laws in January 2023, right? I mean, and then including DC and Puerto Rico. It's definitely taken shape. It certainly has created, continued consternation, for businesses around the number of jurisdictions that are now in the fold for businesses around reporting, right? Registration and reporting. Now, and then when we take a look at the addition, of that, the complexity levels of it, I would say add a little bit of the home rule jurisdictions in there in the states where non-state administered jurisdictions are also trying to bring to light what happens, how do local jurisdictions take part in remote seller business and the value of being able to capture that when the state is not the one who's the tax collector. And states that come to mind, Alabama, Colorado, Louisiana, all have different flavors, right? It's not like there's one size fits all when it comes to economic nexus. And I think that's the big thing. I mean, what we still see today, it probably is no surprise on this slide that 90% of businesses were impacted and are still seeing the impacts of remote seller and economic nexus. But I think what is a little bit interesting is probably 50% of those surveyed businesses answered that the complete transformation when it comes to what's needed for compliance has taken shape. And maybe that's not, so surprising because businesses continue to increase sales channels and the way business reaches new markets and new sellers, right? So whether that's through marketplace and other extensions of ways to do commerce remotely or on e-commerce platforms, or also through physical store and in locations. That's what's interesting as we move to economic nexus thresholds by state. You're probably like, hey, come on, that's one of the things that's kind of static, right? It's sort of settled down, and that's true. I mean, other than Missouri, and it's probably taking Missouri a bit longer, given the wonderful site code reporting that accompanies filing in Missouri today, which certainly is one of the areas Missouri is continuing to try to shape some simplicity around, and maybe hence the later showing on economic nexus laws rolling out in 2023. But across the board, right, the thresholds have been established, in place. It's not an easy recipe, and in a few minutes, Scott is going to talk a little bit more, take us to another layer of complexity. But for the most part, different flavors of sales and understanding those flavors of sales, taxable sales versus gross sales, which gross includes your exempt sales, right? So understanding the flavor of sales is not always the same in states. Understanding even that transaction volume in combination with or standalone, are different variations across states for sure. So I would say, again, it's been pretty static, but I wanted to take a moment on this one to say, as I put my head of U.S. tax compliance, hat on and think about it from what we do for our clients and customers, we are always engaging with from a thought leadership and just from a keeping up with things directly with jurisdictions. And while this map and outcome of economic nexus thresholds is pretty static, it's doubled, tripled, quadrupled the volume of registrations, returns filing, and payment activity in many jurisdictions. Locals sometimes that had nothing in the way of the ability to capture using online, right, paper, to states where you think you have an online account management and a way to serve taxpayers at scale, and you find out it's not with these additional volumes. So what we're continually seeing, forms changes, huge uplifts in website and everything from navigation and particularly around scale, infrastructure, and even security, right? With password changes, multi-factor authentication. There's just a host of things that now the jurisdictions are doing to try to keep up with the tremendous volume and scale that that economic nexus and Wayfair have brought to the table. So again, I think it's a good time now to to take a look in more detail, and I'll turn it over to you, Scott. And I don't know if there's anything you want to comment on there, but let's go to complexity because it gets more fun.
Well, it's as you can tell from Nicole, she's deep into the weeds that these states are growing, and the two things. One, there is a company out there that builds software for departments of revenue, for tax administration. 30 states have use the same company. Almost none of the state systems looks like its neighbors. Even though they all use the same software company to build their software, and there's things in the background that are probably exactly alike, on the surface it's all completely different. And there's the complexity, even in a day and age where there's a lot of technological uniformity, is still enormous. So the last slide, the one that Nicole talked about, was the thresholds. An economic nexus threshold is that dollar amount of sales that you make in a calendar year that once you've exceeded it, creates an obligation for you to collect sales tax in that state. I just did a webinar this morning with the Kentucky cities and counties on the new lodging tax that goes into effect on January 1. And so I spend a lot of time talking to people about boundaries. And the vast majority of sales taxes in this country are imposed by cities. And so in the one thing that cities boundaries do is they change. And cities annex and de-annex all the time. And while the rates may not ever change, it may be, but the city boundaries change all the time. And so as you're managing your process to evaluate where you have an obligation, you also have to keep in the back of your mind, okay, I know I'm collecting sales tax in Louisville, Kentucky, have been for years. Although bad example, they don't have sales tax, but let's say they did. And how do I know that the boundaries changed? I have a customer that's got a Louisville address. How do I know if that customer is inside or outside Louisville? Once again, Louisville's a bad example. They don't have a sales tax. But so that's one thing that when we ask these questions, and my first reaction is, okay, I spend way too much time with local governments, because the first thing that I think of is, are you keeping track of annexations? When the Wayfair decision happened in 2018, it replaced the previous test, which was physical presence. Physical presence is relatively straight down, or not straight down, straight forward. You're either in the state or you're not in the state. I've got employees here, I've got a house there, whatever. And so we all thought it was called a bright line test. Physical presence was a bright line test. Supreme Court comes in, they get rid of economic nexus, they get rid of physical presence, they give us economic nexus, which is economic presence. And I think I mistakenly thought, well, there would just be an awful lot of uniformity. I mean, the law that the Supreme Court used was South Dakota's law, which was $100,000 in gross sales or 200 separate transactions. I just assumed everybody else would copy it. It'd be $100,000 that the whole state would be blue, or the whole country would be blue. Well, that isn't what happened. Almost instantly, states said, well, we're not South Dakota. I'm Texas. Everything's bigger in Texas, so the threshold should be bigger in Texas than it is in South Dakota. Okay, so automatically, Texas has a different threshold than South Dakota does. What surprised me is North Dakota. I mean, North Dakota and South Dakota came into the United States at exactly the same time. Today, no one knows which one of those states became a state first, because the president who signed their orders creating states refused, and went to his deathbed, refusing to tell anybody which one he signed first. Their sales tax was adopted in 1934, the exact same language in both states. Their sales taxes could not be more different from each other today than with a state that doesn't have one at all. So instantly, North Dakota created a different economic nexus threshold. The challenge is it's $100,000. So the economic nexus threshold in South Dakota is $100,000. The economic nexus threshold in North Dakota is $100,000. So you're out there and you look and you say, oh, they're both $100,000. So I just need to know when I cross $100,000, I need to get a license and start collecting. No, not even close to the truth. Because North Dakota, it's retail sales. They don't want you to include your exempt sales. They don't want you to include your sales for resale. South Dakota, it's gross sales. Actually, it's gross receipts. And they want you to count every sale that you make in the state, whether it's a sale to the Catholic Church or a sale to a doctor or a sale to whatever, and whatever it is that you sold. They want them all to be included. And so you can be selling the same exact thing to the same exact type of people in both states, and honestly never have an obligation to collect sales tax in North Dakota, or excuse me, never have an obligation to have a sales tax license in North Dakota, and have an obligation to have a sales tax license in South Dakota the moment you hit on $100,000. So just looking at the map that Nicole showed you doesn't give you enough information to know where you need to pay attention to what's going on in the country. And the rumors I'm hearing is that there may be more uniformity coming, but I'll believe that when I see the governor sign that legislation. So how do they deal with all this complexity? How does a retailer manage complexity, Nicole?
Well, I will say this. So I want to just give credit to Diane Yetter and Sales Tax Institute for that very colorful map you just showed us, Scott. It was awesome, right? And sometimes, again, as we look forward and we think, wow, streamlined sales tax again. What's this about? I mean, streamlined sales tax for 24 states, right, that are participating in streamlined sales tax. This has been around well before Wayfair, maybe in anticipation of, ways to not wait for, not a matter of if, but when, right, the economic nexus laws would take shape. But it's interesting because the benefits of 24 states pulling together and simplifying, as in the name, right, ways in which businesses can participate, and and doing that through a very short list of, but a pretty challenging process to qualify as a CSP or a certified service provider, across that streamlined sales tax program, of which Avalara is one, right? And I always like to take a moment to call it out, because what we see is many businesses have the opportunity in growing, in just thinking about the multi or omni-channel strategy to grow businesses, have an opportunity to participate in this where it's applicable and where they qualify, from a state presence, and also run it alongside of filing and reporting, in compliance outside of SST for states that either are not in the SST 24 or just you don't qualify for. So I think it's an interesting companion strategy when you think about sales tax compliance and reporting. And some of the benefits, again, I know everybody loves the word free. Nothing's really ever for free, so to speak. But from a certified service provider, free to businesses really means that we are taking, as in Avalara or other service providers, a lot of the things we already have in place to make it easier for both the 24 states that are part of SST and for businesses to have standard and accurate rate calculation, across the stack of transactions. The preparation and filing and remittance services are free, and a lot of the rules are a bit more uniform, and that helps businesses across the board. So SST in 2021 changed some of the rules to help with additional businesses participating, and those rule changes really enabled multi-tier marketers, marketplace facilitators, as well as some unique business types. I think about that change in the beverage alcohol industry with the ability, for wine and spirits that are being sold direct to consumer, business models to be part of SST as well. So I put that out there because I think businesses should know that it's not just about all states. You can now be in select states with SST. It's a great companion compliance program to think about from a sales and use tax reporting point of view. So Scott, I'll turn it back over to you. Home rules are fun.
Home rules, I love it. Like I said, it's perfect that I get to do the local governments because I've been, like I said earlier, this is kind of a local government day for me. The challenge for a lot of merchants around the world is that obviously the states are all different from each other, and they're different from what they tax, what they exempt, what the rates are, all the things that go along with being sovereign entities, which our states are. In some cases rolls downhill, and as that ball is rolling downhill in the state, it's getting bigger. It's like a snowball. Imagine a snowball starts off as a little tiny snowball at the top of a hill, and as it rolls down, it becomes this enormous ball. Well, that's the way sales tax compliance works in a number of states, because as you're going downfield on the level of government inside of a state, you start the breadth of issues gets bigger and bigger and bigger. You go from having one state with one rate to 275 cities with each of them having a different rate, each of them having a boundary you have to manage. We'll take that and imagine that you live in a state where the state can't control what the local governments do with their sales tax. And that's the meaning of home rule. From when you hear Avalara talk about home rule, we're really talking about those places where the state constitution gives to local governments the ability to manage their own affairs, including how they implement and administer a sales tax. And the classic cases are Alabama, Colorado, and Louisiana, and to a lesser extent, Alaska. In Alabama, Louisiana, and Colorado, the state constitution gives those taxing jurisdictions the ability to impose their own sales tax under whatever basically kind of rules that they want to create, and it significantly increases the obligation for folks who have to comply with each of those individual differences. Colorado may be the wildest example, where the local governments don't have to tax or exempt the same things as each other or as a state. And so the matrix of what's taxable in Colorado is immensely larger than it is in most states, because you have what the state taxes, then you have what each city taxes, you have what the county taxes, you have a special purpose district, at least in Colorado, tax the same thing as the state. That isn't always the case. In Nicole talked about the streamlined sales tax. Well, one of the things the streamlined sales tax forces on its member states is that the state and the local governments tax and exempt the same things. So Rapid City, South Dakota, which is where I grew up, taxes and exempts exactly the same thing as Sioux Falls, South Dakota, and the state of South Dakota. Whereas Denver, Colorado, taxes and exempts something entirely different from the state of Colorado, or from Colorado Springs, Colorado, where I served in the Army. 3 entirely different tax bases. And if you're someone who has to care about, because you have a presence in those jurisdictions, it gets really complicated very fast. Now, when it comes to economic nexus, each of these states are taking up 3 different ways of dealing with the process. Colorado is moving toward kind of a single point. They have what they call their SUT system, SUTS. And that is a special system that they created to assist remote sellers. And a remote seller is somebody who's outside the state making a sale in the state. And it's designed to give a remote seller a single place where they can register, a single place where they can file a return, a single place where they can make a payment. All the taxability issues are all still remain. All the rate issues are all the problem. All the the boundary issues are still crazy in Colorado. Alabama took a different approach. In Alabama, the legislature said, if you're a remote seller, you don't have to care what the local governments in Alabama do. We're going to give you one place where you can come in and register, and you can collect one rate At least in Colorado, you still have to collect all the individual rates. Alabama, you collect one rate. And that rate is higher than the state rate, the state rate plus a local equivalent. And that then is spread out amongst the local governments in Alabama. It's exceptionally simpler than the Colorado rule, but the Colorado rule is exceptionally simpler than the rule that existed before. Louisiana is trying to do something. Now, they have a remote seller commission. If you're a remote seller, you can do things like the soot system in Colorado, but they still have all the complexity that goes along with the different parishes. And first of all, in Louisiana, they don't have counties, they have parishes. And they have all that complexity. You still have to care about jurisdiction boundaries. You still have to care about taxability. You have to care about being registered. All those things still exist. And while the legislature in Louisiana wants to make things simpler, they're struggling to figure out how to do that in a way that is politically viable in the state. So let's go now and talk about marketplaces. It's gotten so I don't even talk about in economic nexus without combining economic nexus for sellers with economic nexus for marketplaces. So the states, for years, the states have been trying to get, every retailer in the country to collect their sales tax. Well, when somebody invented the marketplace, the states realized, oh my gosh, we've got to get serious about getting people to collect, because these marketplaces are going to be wildly successful, and they're going to drive out my local businesses. So no one will ever shop downtown if they can always shop online, and it gets delivered. You make an order at 8 o'clock in the morning, it's at your house by 9:30. So the states have been after the marketplaces for a long time. And so what they've done is they created a law called a marketplace facilitator law. So they've created a phrase, a marketplace facilitator, that is, and I don't want to use names of companies, but you know who they are. And what they've done is they've said to the operator, the owner of that marketplace, we're just going to deem you to be a seller. We don't care if you're selling your own stuff. We don't care if you're selling somebody else's stuff. We don't care if it's a mixture of yours and theirs. We don't care. We're just by law going to call you a seller and force you to do everything that we would do to a seller. These laws exist everywhere. And for the most part, almost exclusively, the rules for sellers are exactly the same as they are for marketplaces. If the threshold is $100,000 for a seller in the state, the threshold is $100,000 for a marketplace in the state. If the seller has to file monthly, the marketplace has to file monthly. Where it gets really complicated for marketplaces is, first of all, they're complicated businesses. They're selling everything. And when you're selling everything everywhere, you just take it for granted that things are going to be complicated. You multiply your complexity times everything that you sell everywhere you sell it. So the marketplaces have to keep track of exemption certificates. They have to be able to deal with refunds. They have to be able to file a sales tax return to 46 different ways that sales tax returns have to be filed in the United States. And they have to be liable for the audits. They have to be liable for the errors that go on. They could perhaps pass some of the liability for errors onto their retail seller customers, but it's that has to be contractual, and you have to go through an audit to get that done. So it's really complicated and kind of economically painful. Now the advantage for marketplace sellers is that, for the most part, they're off the hook. If you're a marketplace seller, if you're a seller who sells only in a marketplace, first of all, you have to make sure that the marketplace is collecting everywhere, because that's not the case, and because some of these states don't agree on what a marketplace is, so that's complicated. But let's just, for example, say that you sell only on marketplaces and they're collecting everywhere. Well, for the most part, you don't have an obligation anywhere. And that is a real advantage to the sellers. So from the state's perspective, they have created a certain amount of simplicity for individual marketplace sellers, but it came with a catch. They didn't eliminate the complexity. They just shifted it. So it all goes to the marketplace today that once would have gone to 1,000 sellers. And they haven't really done anything for the marketplace to make it simple. So let's talk now a little bit about what's going on in other things associated with tax compliance in the United States and maybe a little bit around the world. So Nicole, tell us about what some of these other states are doing.
Absolutely, Scott. I know we just came off the heels of Economic Nexus, where we talked a bit about Colorado and then home ruled perspective on Colorado. And Colorado, I guess, just wins a prize today for popularity. But one of the things mid-year in 2022 that Colorado introduced was the new retail delivery fee. It is a flat fee. Maybe Colorado arguably would say it's not a tax, but it gets interesting, right? That flat fee that took effect, it is required for registered businesses, and I mean, effectively applies to almost every business. And so what we see with that 27-cent flat fee at a transaction level, really, when there is a shipment, a shipment event or action that is anywhere in the state of Colorado, from in the state or from out of the state. The in-state goal, that Colorado is mandating is, hey, this needs to be visible in the invoice and paid by the end consumer. And that's where it gets kind of interesting, because most businesses yet to have rolled out a means to do that as early as the invoice. Many businesses are still, of course, complying, but doing that in a way by multiplying the flat fee, the 27 cents, against that number of shipments or transactions that apply, and almost paying out of pocket. I don't know what else to say. We still see some of that, Scott. And I don't know if there's anything you'd want to add there, but I think we're still seeing businesses coming up to speed with how it is that the invoicing and the upstream systems deal with that.
So this retail fee caught everybody by surprise, even though it went into effect in 2021. It was passed in 2021, didn't go effect until 2022, caught everybody by surprise. And the Department of Revenue, they don't have the authority to simply say, just go ahead and remit it on yourself. You don't bother collecting it, because the law is very, very specific. What they have said is that because it is complicated doing the actual collection from the consumer, getting a line on an invoice, they're going to ignore the fact that some people aren't collecting it from consumers for a period of time. They've never defined that period.
No.
And we should assume that is going to come to an end. Now, obviously, this is the kind of thing that a department's only going to find out about in an audit, and they're not auditing anybody yet on this. But, well, it's not. Let me say that differently. Every month that goes by is a new audit period for a retailer in Colorado. So if you got an audit notice today from the Colorado Department of Revenue for your sales that run through the end of December of this year, you've got 6 months of this Colorado retail delivery fee that they can look at in your audit. So in theory, they could find this today in current audits.
Yeah. So I think while we see the enforcement of that on the invoice paid by the consumer not yet taking shape, it's still been a pretty big change for retailers to consume. And I'll just put an interesting twist on it. I'm cognizant of time, but just with one little interesting twist on Colorado. What we are seeing now, back to the home rule discussion, again, non-state administered local jurisdictions, over 60 of them in Colorado, are weighing in on, well, does that retail delivery fee, that additional fee being tacked on, do you exempt it from the sales you report as part of any registered Colorado locals, or is it like tax on tax? Do you include it? And it's kind of about a 40-60 split. 40 are actually requiring it to be almost like a tax on tax, and about 60% are exempting. But what I read as I look through sort of the weekly research on that, that's not static. Most of the locals are still taking positions on that. So we expect and continue to monitor change in that area. What's going on in Missouri? Scott?
Mute again. Sorry, I got myself on mute again.
Okay.
So Missouri's the last state to enact and put into place economic nexus. So on January 1, 2023, the remote sellers around the country, around the world, will have to start collecting the Missouri use tax. So this is another place, another concept that complicates a person's ability to be compliant. So if you're a merchant inside the state of Missouri, you have a sales tax license and you collect sales tax. If you're a merchant outside the state of Missouri, you have a retailer's use tax license, and you collect the retailer's use tax. And that is not unusual. It's not common, but Kansas, Michigan, Illinois, Missouri, probably a couple other states, Colorado, they have this view of the world that if you're outside the state, you're not collecting the sales tax, you're collecting the use tax, the retailer's use tax. So when you're going to get a license in Missouri to get ready to start collecting tax on January 1, make sure you pick the retailer's use tax license. Don't pick the sales tax license. Another complicating thing is that for the longest time, many local governments in Missouri never had a use tax. So there was never anything to anyone to collect, which arguably didn't make any difference because no one's going to collect it anyway. But come January 1, everybody's going to have an obligation to collect tax in Missouri, but you still have to pay attention to the local rates, because if that local government you have a customer in only has a sales tax and doesn't have a use tax, you don't collect that tax. You collect the state's use tax. It's a crazy complicated. For some ways, one of the more complicated states in the country. A, they have like 2,000 jurisdictions, and B, they've got this use tax differential that's just honestly very hard to keep track of.
And for these next two, Scott, let's try to run through them. I know that there's the big changes coming up, but we're getting a little bit short on time. So let's see if we can run through them a little bit quickly.
Yeah, Nicole and I like the sound of our own voices. Thank you very much. So a couple other things to bring everybody's attention to. Starting January 1, Kentucky is going to expand their sales tax to over 30 new services. Now, for the most part, this impacts people only inside of Kentucky. There's very few of the services that Kentucky is going to start to tax that are delivered remotely. But if you're in Kentucky, you should probably take a look at that list of services, repair services, household moving, tattoos. If you're in the tattoo business, you're going to start collecting sales tax in Kentucky. Cosmetic surgery. On January 1, Kentucky will be the first state in the country to tax a legitimate medical procedure, which is cosmetic surgery. Also in Kansas, and this change affects everybody that sells food, whether you're inside of Kansas or not, they're going to start lowering the sales tax rate on groceries. The good news is the definition of food in Kansas is the streamlined sales tax one, so it's used in 24 other states, so you have a pretty good idea what that definition means. But they're going to phase. This is going to take multiple years to get done. So, so pay attention if you're in the grocery business. Pay attention to what you're selling in Kansas, and be prepared to collect less tax come January 1.
Let's talk a little bit about taxation in the digital age. So Scott, I'm going to pass it over to you for this section. I do want to spend some time on Maryland. I think the next two slides on NFTs and the metaverse are interesting. I don't know that we need to spend a ton of time there, though, but let me pass it over to you.
Very good. So there's been a lot of press about the digital advertising tax. And for the most part, the press is around what's going on in Europe. What Europe is doing for digital advertising taxes is a little bit different than digital taxes is different than what Maryland did. So what Maryland did is they passed an excise tax on the receipts a person receives from providing digital advertising to consumers in Maryland. And it was challenged instantly. It's been in court ever since it was enacted. The state court has said it's unconstitutional or a violation of the Internet Tax Freedom Act. The federal court's trying to figure out why in the world they're involved. We're not done yet with where this is going. Everybody's appealed, and so the state's appealed, the business community's appealed. We're quite a ways before we know whether or not that tax will survive, and if it does, what shape it will look afterwards. Non-fungible tokens. So non-fungible tokens, they're new. They came to us from the blockchain and cryptocurrency. They are effectively a receipt, and or if not a receipt, they're a form of title. So you buy an NFT. What you get with that NFT is ownership, proof of ownership of something that you bought. The states are slow, very slow to decide whether or not their existing tax applies to the underlying component of what the NFT represents. Most states have said that an NFT is a digital good. So to the extent they attach digital goods, then they would tax the NFT, but it's still a function of what the underlying thing was. So if the NFT was for a piece of art, if the state taxes art and the state taxes digital goods, they should tax the NFT. If it's something they don't tax, then just because someone bought an NFT, bought it in the form of an NFT, doesn't make it automatically taxable. So we've got a ways to go on this. Washington has said something, Pennsylvania said something, Minnesota and Wisconsin are talking about it. Every state will eventually, certainly within the next 6 months, come out with an answer on it. But it's going to come down to the whether or not the thing that is the thing that the NFT represents is otherwise subject to sales tax in that state.
Yeah, Scott, I think it's a great segue around the future, right? Because NFTs also, while built on blockchain, almost all of the transactions still for NFTs are traded in cryptocurrency. So even a little bit more complicated to navigate. And then there's the concept of buy, sell, trade. It's almost, the NFT almost enables a certificate of authenticity, almost like trading stock, right? Even though there is an underlying good, or in the case, of our own exchanges, a certificate of a physical ownership of a stock. They're, often they're being held and sold before ever taking position. And I think that, again, is going to continue to shape why this space is going to be so challenging. Both the way the digital currency is transacted, where it's transacted from a platform perspective, but boy, does it lay out some fun stuff for the future and where technology's headed. So tell us a little bit about the metaverse, what's going on.
Absolutely, I appreciate that. And so the metaverse is that virtual world that some people go to visit once in a while. What makes it interesting is that it's a legitimate form of entertainment, and it's going to become a legitimate form of lots of things in the future. Because architects are already starting to use the metaverse to imagine what a building would look like, or imagine what an interior would look like. And certainly interior decorators will take over this space, and they'll say, "Let me show you what your house will look like when I'm done." And you'll put on these headphones or this visor in, and you'll walk through your house. There's going to be a fee for that. And it's the fees that get charged inside the metaverse that creates tax questions. Not a lot of states tax digital goods, or honestly, a lot of states don't really know how to imagine what the metaverse is or what it will be. But it still comes down to, if you live in a state that taxes everything, Hawaii or New Mexico, those states tax everything. It doesn't make any difference what you're selling. Literally makes no difference what you're selling. It's taxable in those states. And so they don't think about the metaverse differently than, say New York would, which, doesn't tax a lot, or California, which doesn't tax a lot actually in their sales tax. New Mexico says, of course it's taxable. I don't care what you charge. I don't care what you're selling. It's taxable. California and places like that, they're going to take a long look at this. They're going to say, well, what is it you're actually buying? Is what you're buying otherwise subject to our sales tax? If it is, then the fact that you bought it in the metaverse makes it a taxable transaction, and whoever's operating that has an obligation to collect sales tax. So it's much like the NFTs. It's going to be a function of what is and what isn't. If I buy a purse in the metaverse, Is it subject to a sales tax holiday in the state that exempts purses? And who the heck knows? States haven't said. We're like, as Nicole said, this is the wild, wild west of retailing and sales tax compliance. So we're going to go to e-invoicing. Oh, that's me. Thank you. So e-invoicing is a way for governments outside the United States to create uniformity in the way that we conduct business with each other. This started with business to government transactions. So I'm the government. I want to reduce the amount of money I spend dealing with the thousands of people who provide services and products to me. So I'm going to create an invoicing standard. You want to sell to me, you got to use this standard. And it's now being expanded out to other business-to-business transactions. Eventually will go to business-to-consumer transactions, and is now becoming part of tax compliance. So one of the ways that the European countries are reducing the we'll call it slippage in their tax system, the fraud or the non-compliance, is to require that the invoices come to the government before they're sent on. So, and there's a half a dozen varieties of how this is done, but the point the governments are trying to make is, I'm not going to let your value-added tax invoice go to the next level and be a legitimate invoice unless you give it to me first. And this will roll out. It's continuing to roll out. More countries will adopt it. There's a test program inside the United States that's run by the Federal Reserve, and it's really more of a. I think it's starting off today as more of a how do I sell to the government kind of concept, like I did in Europe. But this is the future. And so if you're an international business, e-invoicing is a thing you have to understand, and you have to be prepared to deal with the different standards that the different countries are creating and get this back and forth inside your process.
Yeah, and Scott, it's interesting. I mean, e-invoicing is really more about VAT systems simply because it's a way across the value creation chain. It's very different than the way we look at indirect tax in the U.S. So, I mean, just a comment on that. I don't see e-invoicing being foundationally anything that's super valuable as we think about indirect tax in the U.S. But it does bring up that, well, if there's more real-time data moving back and forth, whether it's in U.S. tax systems or e-invoicing and international VAT, I do think that the more data moving around, the more real-time data moving around, it really does open the door for thinking differently, U.S. and abroad, of what jurisdictions can do in the future to accelerate, maybe payment and the frequency or the means in which we look at reporting and filing here in the U.S. as well. I do think it's that acceleration of real-time data that brings about a lot of changes. And I think that's applicable here in the U.S. as well. We'll see those trends.
I did have one question that came in about SST, and I wanted to call out really quickly. We did not include a map in this slide of the 24 SST states, but if you're interested in learning more about streamlined sales tax or which states are participating, you can go to avalara.com/SST. We do have a map on that page, so I just wanted to call that out. I got an interesting question, though, on the IRS hiring. This person says 87,000 new armed agents, and she was interested in who they're going to be targeting. Any insight into that on what the IRS is going to be targeting in 2023?
They aren't going to be armed agents. But that's
armed with a pen, maybe.
They're going to certainly be armed with a pen. No, so the number one need in the IRS is people to answer the phone. So a good share of that 80,000 are going to go on their helplines and be there to answer questions. There will be some that go into auditing, and there's over the years they have been so starved for resources that the number of people who get audited, whether it's you and me or billionaires or multinational corporations, they've all auditing the IRS has been starved for funding, and so there'll be more audits conducted. Honestly, you need to remember when you're thinking about auditing, whether it's at the state level or at the IRS, it's like that old political ad with Willie Horton. Why'd you rob the bank? It's because that's where the money was. Well, no state auditor, no IRS auditor wants to audit somebody just for the heck of it. There has to be a legitimate reason why that person. Often auditors don't pick audits. First of all, there isn't an auditor in the country that has the authority to pick who they're going to audit. That's done by a central organization that wants to make sure that audits are done for the right reason and not any other reason. And whatever that reason may be, it's not because I decided today I'm going to audit you. That doesn't exist. But no, yes, the overwhelming, like I said, the number one need in the IRS today is for people to answer the phone, and a good share of those people will go for that purpose.
Yep. All right, let's see. I had a question that came in about third-party sellers on marketplaces. So this person is asking, are third-party sellers required to report sales through marketplace facilitators as part of their gross sales on their sales tax returns? I think we talked a little bit about that, but any clarification?
It's a yes and no. It depends. There a number of states. Yeah, a number of states have said no, don't bother doing it. But there's quite a few states that let's go back to the concept of economic nexus, and we talked about those states that are gross receipt states versus those that are retail sales states. They also, in many cases, don't want you to count your marketplace sales in your own threshold. So North Dakota, for example, North Dakota doesn't expect you to count your marketplace sales in North Dakota in determining whether or not you yourself have an obligation to have a license in North Dakota. South Dakota does. Another distinction. So if you're selling into South Dakota, you have to count all your marketplace sales in your total to determine whether or not you have an obligation to have a license with South Dakota. So that same concept flows through to the tax return. If I have to file a sales tax return into a state, first of all, I should only be given that state the state-specific information. So if you choose to give your marketplace sales on your sales tax return for a state, there's no reason for you to give them the sales that occur outside their state. I mean, they care about the sales inside their state. They expect to see what you're doing inside their state. So don't.
Yeah, Scott, I think where it gets interesting, though, is we can be reporting, right? There may be a requirement to report sales, including marketplace sales for a seller, but understanding from a market seller perspective, which marketplaces are collecting and remitting so that you don't double pay. I think that's the business beware piece that you and I see quite often, right? Yes, you may be including the sales. Yes, you have to report the tax liability that remains as an obligation for a business to pay that may be outside of the remit of those marketplace sales that somebody else has remitted on your behalf. But please, understand where. I think that's for businesses. Understand where it is those marketplaces have remitted on your behalf and make sure that you're not double paying on that tax liability when reporting, even if the sales portion has to be included. And that varies state by state for sure.
Yeah. And going back to this marketplace, someone asked for a definition of marketplace. And I think that definition of what an actual marketplace or marketplace facilitator is has some slight variances by state, right?
They are different. There's basically a broad version and a narrow version. And the definition really varies by how much of the process you're involved in. So it's a marketplace is someone who assists others in making sales, basically at its basis form. They use the word facilitate. So someone who facilitates the sale of other people's products. You know, an antique mall. And so in its oldest version of this, an antique mall is a marketplace facilitator. I mean, you walk into an antique mall and there's 50 booths in there. Well, the person that owns the mall doesn't own the booths, that's somebody else's, but that person who owns the mall is facilitating the sale of everybody else's product. So, and then it's a function of whether or not you handle the money, whether or not you handle the facilitation of the delivery, and all the other things. But it's basically, are you helping to facilitate the sale of someone else's product?
Okay.
And not the yellow pages. So the one thing that everyone, the one uniform thing in marketplace facilitator laws is everyone exempts from the definition people who connect a buyer and seller, but otherwise have no involvement in the sale whatsoever. If all I do is create a process where a buyer goes out and looks for something and they see it on my site, and then they connect directly with the seller, that's not a marketplace. You have to do more than just simply connect a buyer with the seller.
All right. Well, Scott and Nicole, thank you so much for being here today, for sharing your expertise and your knowledge with it. I know I always enjoy listening into the conversation, and I hope that our listeners got some valuable information that they can pull out of today's webinar as well. Our 2023 Avalara tax changes written report is available now. It's hot off the presses, and it has over 110 pages of in-depth information and graphics on the topics that we covered today, in addition to a lot of other topics that we weren't able to dive into. So if you haven't seen it yet, I would definitely recommend using the link on the console to take a look at it, and even bookmarking it as an ongoing resource. It's something that we're going to be updating over the course of the next year with the latest information. And with that, to all of you out there in tax land, thank you so much for joining us for today's webinar. As I mentioned, we hope that you found some valuable resources in it, and we will see you for one of our future webinars very soon. Bye, everyone.